Moving on to revenue and expense recognition principle. So because revenue and expenses correspond to a certain accounting period, right? Our revenue from 2021, right? Our expenses from 2021. We want the expense that we're incurring, expense, not expenditure. Expenditure just means, some cash you pay. We want the expense that we are incurring to match the benefit that we're received, whether that's in the form of revenue or any other kind of economic benefit that we're receiving, right? There's different kinds of economic benefits. So we want them to match in the same time period. Cost of goods sold is a great example. In 2021, let's say we are manufacturing inventory to sell, but we don't sell this inventory. So we're incurring expenditures for this inventory that we're going to sell in 2022. It doesn't make sense to record an expense in 2021 when we're making this inventory, when we know that we're going to sell it in 2022. We want the expense of cost of goods sold, which we record at the time of the sale, right? At the time we're receiving revenue, right? We're recording revenue. We want the expense to correspond in the same period that we're receiving some benefit from the underlying thing. Depreciation, also, we record over time, not when we buy property, plant, and equipment. The expenditure for property, plant, and equipment can happen, whatever, 20 years ago, 10 years ago. When we buy a truck, we buy the conveyor belt, like we buy the facility, but every period we are receiving some benefit from operating, from using these assets in our business. So we need to allocate as an expense a portion of that property, plant, and equipment in the period that you're receiving some benefit. Because what is a business without its assets, right? You cannot operate without its assets. Unearned revenue as a liability. Let's see. Yeah, even if you receive cash in advance of performing some service, you wouldn't record revenue until you've performed that service. And so you could receive cash in one year, but you don't perform the service until the next year. You would only record revenue at the time that you finally perform the service, not when you receive the cash, because you haven't earned the cash yet, even though you have cash in the bank. Let's go hit on the second point. Prepaid expenses, you might, or like rent, you might prepay 12 months of rent, but you haven't, yes, you prepaid 12 months, you've paid the cash, but you haven't used up that rent. So if you're paying rent, then you wouldn't record rent expense until, if it's month to month, until the month that you have, already lived in the place. And if you're the landlord, you wouldn't record revenue until that month has passed and you have provided the service of providing a place for the tenant to live and you have earned it. Right? If the place burns down the day after you pay for, for the rent, there's no way of performing a service obligation, so no one has a revenue expense.